Well, it's 9 o'clock, so we'll go ahead and get started with this month's aftermath webinar. Thank you for those jumping online to join us this morning. This is the Friday the 13th edition, but when we get into the markets, you'll see that that's not such a bad thing today. We've got some higher trade across the board here today, so nothing too scary about what's going on here today. Yesterday did have a USDA report. We'll dig into that as well and talk about everything that's relevant to the markets for crop insurance, government programs, the big three things. So as we start right now, here's what I see the biggest factors in the market at the moment. Number one continues to be, or 1A, 1B, and 1C, I guess, but the top of this is the crop sizes here in the United States. Looks like we're going to have some record crops this year. According to USDA, both corn and soybean yields expected to be records. That's not the case with cotton, certainly, and maybe not the case with some of the wheat types of wheats. But nonetheless, we're going to have a lot of bushels to deal with. The other side of this is this big tug of war that's been going on for several months now between the funds and the producer. And as you go back a month ago at this time, we were seeing heavy producer liquidation of old crop bushels. That was weighing on the market. Funds have been short these markets for a long, long time. But some of that reversed over the last few weeks. You started seeing the producer selling slow down as harvest started, as liquidation of old crop got finished up. And you started seeing some of these funds buy back some of their short positions. And so we've seen some movement both directions, and we'll dig into the charts here in a few minutes. Well below those, but certainly factors in the market, the macro influences. And I think that's one here this morning in the wheat market. This war between the Ukraine and Russia looks like it's possibly going to step up. Talk about allowing the United States and others, NATO, allowing missiles to go deeper into Russia. That's possibly going to step this thing up a notch. And I think that's what's bringing some buying into the wheat market this morning. And then you've got South American weather, which they're just at the very beginning of the planting season, but certainly that's a month from now, we'll be talking more and more about that. So with that, yesterday's USDA report, these were the yield numbers from yesterday. Corn, they surprised us at 183.6. That was a half a bushel higher than last month, more than a bushel higher than the average trade estimate. So by itself was a little bit bearish. Beans, as expected, no change, 53.2 bushel per acre. Did have some people thinking that number could be bigger. And so the fact that it wasn't maybe was a little bit bullish for the market yesterday. When you look at ending stocks in the United States, the one bullish number that sticks out here was in corn and old crop. USDA dropped that number by 55 million bushels this month, down to 1.18 or 1.812 billion bushels. That's the smallest number that carryout has been all year. So demand has picked up on corn, and even though that's still a big number, it's not as big as the 2+ billion that we were talking about just a few months ago. Now for new crop stocks, still above 2 billion bushels. Beans still above 500 million bushels. So both of those numbers still very, very large. Wheat didn't see any changes in yesterday's report. In South America, I would say the old crop somewhat negligible at this point. USDA did make a slight drop in the Argentine bean number. But looking ahead to new crop, these numbers didn't change, but they're still very, very big numbers. Corn, both in Argentina and Brazil, big numbers. Soybeans, both countries, big, big numbers. And so we'll show what that means when we combine these all later on. World stocks yesterday, USDA lowered the corn number, almost 2 million tons. Extra demand. So again, the lower prices have done what their job was to do, and that's create some demand. Beans, not much change. Wheat, not much change to talk about there. So looking at where we're at here in the United States, harvest-wise, corn as of Monday was 5% harvested compared to 3% average. But a lot of what we're going to be looking at over the next couple of weeks is going to be this condition report. And I realize that we don't change the size of the crop a whole lot from here on forward. But nonetheless, it can have a little bit of an impact on yields going forward. So 64% rated good to excellent. That was down a point from the past week. In soybeans, 65% rated good to excellent. That was unchanged from last week. The cotton crop continues to dip, 40% good to excellent, down another 4 points this week. 8% harvested, running a little bit ahead of normal. Spring wheat crop's almost out of the field right now, still running a little bit ahead of normal, and winter wheat planting just getting underway. But a lot of focus on the drought monitor and the change over the last 30 days. If you look at just the change from last week, the area of corn in drought went up 5 points to 18%. Now, it's been a historically low year. We were in single digits here just a few weeks ago. So, historically, this has been one of the lowest drought years we've ever seen in corn producing areas in the United States. And I guess that's why the government's telling us we had a record corn crop this year. But sorghum up 2 points, soybeans up 7 points. And so finishing weather, especially for a crop like soybeans, not necessarily the best. And so we'll see if that does have an impact down the road on yields. I think that did limit, or maybe part of the reason USDA did not raise the yield in beans like some had thought. The other big story going forward, it seems like this is a repeat of the last 2 years, but the Mississippi River continuing to fall out here as we get into harvest. This is in New Madrid, Missouri. The river gauge there continues to show now below normal, I guess you'd say. This is kind of typical for this time of the year, but we're getting a little bit lower than where we've typically been. We're down back where we were last year. And so dredging starting to take place in some areas. We're starting to see some draft restrictions on the river, which means it's going to cost more to get stuff to the Gulf, which means our beans are going to cost more for the Chinese to buy out of the Gulf, et cetera. So may see some additional trade off the West Coast under that circumstance. We'll see what happens as we go forward. But the forecast not looking very good here for the center part of the country, getting much water. The other thing we're going to watch is South America. Brazil starting to plant right now, and I mentioned this not really a factor yet, but it's kind of in the back of people's minds. And so you start looking at some of the rivers in Brazil running possibly at the lowest levels ever. Soil moisture right now, this is a fresh map this morning, continuing to show much of Mato Grosso and some of the key early areas very, very dry right now. And so that's going to slow the planting pace down as producers down there decide they want to wait on some rain to put the crop in. Very wet down in Rio Grande do Sul and down into Uruguay. So those areas, they were droughty a couple of years back. They had a good crop last year. It looks like they're going to be moist as we get started. So we're going to be watching the forecast there. The latest I've seen out through the beginning of October still looks pretty dry. So I wouldn't anticipate any early planting to be at a very fast pace down in that part of the world. I guess the 10-day map we're seeing this morning still shows water down into Rio Grande do Sul. Not much up here. Mato Grosso right here in the middle of Brazil and on to the east. Not a whole lot of rain expected over the next 10 days. So something to keep an eye on there. El Nino, La Nina, what's going on there? Well, we are transitioning into La Nina as expected. This was discussed for several months. You go back to last winter. We were talking about the transition expected into La Nina this year, and the hope for this year's crop in the United States was that this transition would push back later into the year. If La Nina kicked its head up in June, July, could have a very negative impact on the crops in the United States because La Nina typically brings drought with it coming from the Southwest, moving up into the United States Midwest. Now, that's what happened. We pushed this thing back. And you can see that the real arrival of this thing now is expected to peak right into the middle of the winter, early part of winter. And so couldn't have been much better off as far as the crop this year went, that we continue to see neutral conditions all the way through most of the crop year. Maybe you could argue that finishing weather for double crop soybeans has taken a little bit of a hit because of some dryness, but this is about as good as you can expect when we're having a La Nina. And looking ahead to next year, what's going to happen? Well, looks like the La Nina is expected to dissipate as we go into spring. And we're expecting to return to more neutral conditions and even starting to see an El Nino start to bud. So I don't think you could ask for anything better. You know, we get these cycles and a lot of places. I know Dr. Louis Thompson at Iowa State always talked about the 18.6-year cycles. A lot of these cycles do continue to happen. Sometimes they just peak in the odd months of the crop cycle. And so from that standpoint, it couldn't have been any better, I guess, this year, except for the winter crops, maybe being dry, but couldn't have been any better for spring crops, it looks like, as far as the timing of the La Nina this year. The other thing we'll hit on as we get into the crops are the funds. The managed funds have started to buy back a little bit of their short position. You can see that they've covered from about 650,000 contracts short to 450. So they've covered almost a third of their net position across the board in the crop markets. And the only disappointing thing, I think one producer told me, he said you would have hoped that if the funds bought back a third of their short position, that maybe the markets would have rallied more. Problem is that the farmer's been selling into that rally, and so we had a lot of old crop grain get shipped over the last month or so, and that's kind of offset some of the buying that we've seen from the funds. So let's start out with the wheat market today. I never start out with wheat, but I thought this morning we'll mix it up a little bit because wheat is the market that's leading the way here today. And a lot of that, as I mentioned earlier, because of the geopolitical situation between the Ukraine and Russia. And the fact that what happens if Ukrainian missiles start going further into Russia? What's Russia's retaliation going to be? What happens out of the Black Sea as far as shipping of wheat goes, both Russia and Ukraine? And so all of those factors kind of coming into play here this morning, and I think it's triggering some short covering from some of the funds. But this is a different topic that was out a couple of days ago, but Russian wheat exports remain flat as the harvest outlook worsens. And when you look at the world numbers of wheat production, you can see here on the left-hand side that the Russian crop, or the former Soviet Union crop this year, down about 9 million tons from a year ago. Yesterday, USDA did bump it slightly. They did drop the EU crop 4 million tons yesterday, and the EU crop is down over 10 million tons from last year. So just those two together, we're down 20 million tons of wheat coming out of that part of the world. Now, we've made up a little bit for it on Australia and Canada this year, in the United States. And so we've shifted that supply, I guess you could say, from the east maybe to the Western Hemisphere a little bit. And so what does that mean? Are we getting more business? I would say yes. So far, the United States has seen a little bit more export business over the last several weeks. And so that's been a nice factor for the market. Look at overall world ending stocks, expected to drop 8 million tons this year. You can look at the stocks and stocks to usage numbers here on the right. We've kind of been declining for the last 2 to 3 years. And so while that's not necessarily bullish, at least it's maybe stopped being as bearish to the wheat market. So looking at exports, what's happened here? Well, export values, and you go back a month on this chart, look at the black line here. We had bottomed out in the value of U.S. wheat, and it shouldn't be any surprise that we've seen some decent export purchasing over that month, from the middle of August on into early September, and that's what's driven the market back up. Or prices have gone back up. Futures prices have gone up too because of that demand, and so everything kind of ebbs and flows, but now you're seeing U.S. wheat at the highest price on here, along with Canadian wheat. Now, the question is, what does the war do to Russian wheat? Can you ship Russian wheat? How much can you ship, et cetera, if that thing escalates? And so that's something that we're kind of keeping an eye on as we go forward. So yesterday's report was nothing. Didn't see any changes at all. So nothing to talk about there. Ending stocks at 828 million bushels, still higher than a year ago because we did have a good crop this year in the United States, but we do have a lot more to ship. World U.S. stocks to usage, going up for the second straight year. World continues to slip a little bit with a decline in the EU and the Russian crops this year. So net positive for U.S. demand. Looking at the fund positions in wheat, and this will be updated this afternoon. We'll get updated commitment of traders report, likely showing that the funds bought back a little bit more yet. But as of a week ago, these funds were still short about 40-some thousand contracts of Chicago wheat. But you can see what they've done over the last 2 to 3 weeks. They've been net buyers. And the impact it's had on the market. December wheat has rallied almost 75 cents off of its low that we made back in late August. And again, that's been driven by some of this fund buying, some of the export buying that we've seen in this market. Looking at the indicators at the bottom, moving into overbought conditions pretty quickly. And so kind of put a caution light out here. I'm probably going to have wheat in the hot zone this afternoon on my email letter when we come out with those numbers. Because we've moved the RSI now up to 65. The stochastics have pushed well up into the 80s. So this market could be ripe for a little bit of a sell-off, and we're nudging right up against that $6 mark. The natural target here, I think, is the 100-day moving average, which happens to be sitting just about exactly where the early July high was, 615, 616. And so if I'm looking to make a sale, probably got some offers at 610, maybe at $6. And watch this thing pretty closely here over the next few days. Take advantage of this rally that we've had. First time we've had really the indicators moving up into overbought conditions since, clear back in May when the market topped out above $7. Kansas City wheat, looking at hard wheat, still a record short for this time of the year, but the funds have been buying over the last few weeks. Probably going to show today that they bought back several more contracts, so they're starting to even that position up. And this chart looks identical to Chicago wheat. They've been moving in tandem lately. The RSI at 63, stochastics up into the 80s, indicate again this market's getting probably a little bit toppy. So we'll see how we close going into the weekend. Again, resistance, probably the upper July high at 617 3/4. We had the 100 and the 200-day moving average just above 6 1/4. So, anywhere up here, 610, 615, probably not a bad place to be selling some old crop wheat. Take advantage of this 80-cent rally that we've had in Kansas City wheat. Looking at spring wheat, Minneapolis wheat, funds bought back a little bit last week. Probably going to show again this week that they bought a little bit of wheat. So that's a positive there. This market's certainly tanked over the last 2 to 3 months with the size of the crop it looked like that we were going to have in the upper Midwest. And now we're seeing the market rally a little bit. 70 cents off the low. Again, RSI at 61, stochastics 90 and 82 would indicate we're getting a little bit toppy here. Now, I don't know if we can make a push back to that July high at 654, which is a little bit below the 100-day moving average, but I'd probably have some offers lined up in that 640 to 650 area, just in case we're able to nudge a little bit higher. Looking ahead to new crop, and we'll talk about crop insurance here in a few minutes. But Chicago and Kansas City July wheat contracts have both been rallying through the pricing period, which means that the average that we're going to have is going to be below where the market's at right now. And we'll look at those here in a few minutes. But from a pricing perspective, the chart looks very similar to old crop wheat. You've got a high up here at 646 and 638 in early July, and both of these contracts, both of those numbers sitting basically right at the 100 and the 200-day moving average lines. And so I think that those are really good targets to be able to make some sales for folks that are going to plant some wheat this fall. You want to start getting a little bit priced. You don't want to price it all at the same time. I'd probably be looking at 10 to 20% increments. You get Chicago wheat up around 630, 640, Kansas City wheat up around, similar levels. Probably not a bad place to be making some sales here for next year's crop. The other thing is you're able to improve on the crop insurance average, which I think is always one of the things I want to do from a marketing perspective is to sell higher than what I get my revenue guarantee set with. Switching to corn, we haven't been able to say this too many times either, but corn's been the follower of wheat here lately. And so the wheat rally has been pulling corn along with it. But this is still my top chart that I have in corn this month. And that is the stocks to usage to price chart. And stocks to usage continues to rally. We're up around 14.2%, even with stronger demand. Stock numbers still continue to rise. Price continues to slip. USDA lowered the average farm price to $4.10 this month. We've talked about this for a year now, but we're really still mirroring what happened a decade ago when stocks started to rise, prices started to fall. And so then the next question is, what's going to happen? Either we've got to really trigger some demand or we've got to cut back on supply to get this trend to change. So what happened in yesterday's report? Well, by the way, I forgot to mention, but we did not get any production updates yesterday. So if you were looking for that, nothing there in the September report. In corn, these are some of the charts that USDA provided to us following the report. the good to excellent category has dropped a little bit over the last month. And so it led a lot of people to believe that we would see maybe a dip in the yield, but that's also pretty common for this time of the year. And so, maybe that's just what happens. And so USDA didn't make any significant adjustments. But yield came in a half bushel higher than last month at 183.6. Big shock there, a little bit to the market. So that added to the production. If you look at the state changes from last month, the blue states got bigger, the red states got smaller. The ones with the pound sign are looking at records. And as you look across the Corn Belt, the significant states for corn production, you've got Iowa, Nebraska, South Dakota, Illinois, Indiana, Michigan, Wisconsin, all with record yields this year. In addition, Mississippi, New York. So you've got a few others. And the one thing that stood out again this year to me, and I know there's some exceptions in the Southeast, but the big producing states, nobody had a bad year again this year for the second straight year. It seems like before that, we would have good crops, but 2 years ago, Nebraska had a lower yield and South Dakota. Last year, didn't have anybody with a substantial drop. This year, nobody's got a substantial drop. Yes, there's pockets, but when you look at the big states, and so that's what it takes, I guess, to raise a record corn crop here in the United States. And I thought this was an interesting chart that they included as well. This is showing yields from the satellite view. So you can see right through the heart of Illinois up into the heart of Iowa, eastern Nebraska, eastern or western Indiana, north central Indiana. That's where the big yields are expected to be seen here this year. I did think this was an interesting chart. Crop Profit put it out yesterday, and I thought, or a couple of days ago, I thought it was interesting to include the change in the drought monitor. And so, again, will we see USDA make some changes down the road? I still think there's some people that think that'll happen. I'm not convinced that of what's going to happen going forward, but I think that there's people that think that this 183.6 is probably the high for the year. Those are probably the same people that thought the 183.1 was going to be the high guess for the year. So that didn't happen. So we'll see what happens with this drought monitor here over the next several weeks, and if it's enough to change that yield as we go forward. Production came in at 15.2 billion, the second biggest crop we've ever had to last year. And so back-to-back big crops, boy, that's not necessarily friendly for the markets. And yesterday's guess at 15.2 billion at the high or above the high end of all of the trade estimates. I don't think there was hardly anybody thought USDA would raise the yield. And so that fact that happened was bearish initially to that market when the report came out. Now, when it's all said and done, if you look at the whole balance sheet yesterday, yes, USDA raised yield, but they also raised old crop demand. Ethanol demand was up. Export demand was up. So old crop ending stocks were down, I believe, 55 million bushels to a market year low at 1.812 billion bushels. By the way, we will have a stocks report on September 30th. USDA will put out this final number for last year. Should be around this 1812 number, may have a few little tweaks in it. So the bottom line was a slight decrease in next year's ending stocks down to 2.057 billion. Now, it's still above 2 billion bushels. And that's even with demand at 14,965. And you look back a couple of years back when we had not record exports, we had the highest export number we've had in several years. Back when China was in the market and we exported 2.753 billion. We still didn't use as much corn as what we're expecting to use this year. And so I think that's very impressive that, we've said back in the winter last year that the job of the corn market right now is to go seek out where demand is going to be able to chew through these bushels. And we've kind of done that. We've got demand up close to 15 billion bushels. And so part of that's feed demand. We're building back the herd slowly. Ethanol demand is maxed out. This 54 whatever numbers, probably as much as you can use in ethanol, given the plants that we have in production in the United States. If you're going to see more growth, it's going to be on the export side. And just about all of the buyers of corn have been ramping up purchases with the exception of China. We don't have China back in the market at this time. That may have been a 1 or 2 year deal back then. We'll see going forward. But right now, the Chinese economy and Chinese animal numbers don't really support them being a buyer of U.S. corn. So the good and the bad, the good is that number didn't get bigger. The bad is it's still above 2 billion bushels of corn as we go into next year. So you can see who's been buying this marketing year, this past marketing year. Again, China well below what it had been a couple of years ago, bought just a little bit of U.S. corn. Some of the increases, though, Mexico bought more, Japan bought more, Colombia bought more. Those have been some of the big three. South Korea is usually a good buyer of U.S. corn as well. So it's been nice to see a bounce back in export demand here this year. Looking ahead to new crop commitments for the 4 or 5 year as of the end of August. Noble put this out. Again, China hasn't bought a kernel of corn for new crop. Now, that's the negative news. The positive news is that purchases so far, sales have been above what they were running a year ago. So not back to where we were in 2020, 2021, but still starting to see some improvement. So looking at the export or the, ending stocks matrix, plugging in USDA's current beginning stock number, the demand number, 2.057 billion bushels. If we would have been down at some of these trade numbers, the trade was expecting 182.4 as an average guess. If you couple that with the higher demand from USDA, would have taken stocks down below 2 billion bushels of corn. And you can see here the green represents stocks above 2 billion. So we've had, given the demand we've had, we had to have this big crop in order to keep stocks above 2 billion bushels. And that's what's happened. So as we head into next year, we're going to be thinking about some of the same stuff. Will we see a trend line yield again next year or above trend yield again next year? What are the odds of that happening? Probably not tremendous odds. You would think at some point we would back off a little bit. But if this demand continues at the current price levels, then we've probably need to not lose corn acres, probably need to have a good crop again next year to keep stocks at anywhere close to 1.8, 1.9 billion. So it's a little early to get into that, but I do think it does matter because I think it affects what the funds decide to do with their net positions. And will the funds be buyers? Will they buy back some of that short once harvest gets mostly over? You can make a case for that. I think that these funds would say, you know what, maybe the worst is in at this point, and maybe we've got some potential for some improvement in price. The other thing we'll be watching is South American weather and see what, if that drought down there continues as we get into the growing season as well. But looking at U.S. and world numbers, U.S. stocks continue to rise. World numbers continue fairly flat. So, which tells us that the demand has been improving. And that's what we've seen here as we've looked at the charts. So the funds, well, here we are starting the new marketing year. Funds are short nearly 200,000 contracts of corn. I bet when we get the report this afternoon, it's going to show that they bought back a chunk of that. And so, yes, it's a big short position. But that said, they're starting to buy back a little bit. And so will they get back to zero? What do they want to do with their net position? They were short the entire year last year, marketing wise. So do they have enough reason to want to buy it back? Do they have enough reason to want to get it long? I think the next chance of that is probably up to South American weather. I don't think there's anything here in the United States that would cause the funds to want to get long at this point. So I do think it's going to be the Southern Hemisphere weather that would be the driver in this market here as we go forward. So looking at December corn, a busy chart on here. First, let's start at the bottom and work our way up. If you look at the stochastics and the RSI, we're nudging back into the hot zone area. We got the RSI at 57. You got stochastics now up into the 70s. So we're nudging to where it might be pushing into a little bit of an overbought type market. We bounced off the low. What are we, 25, 26 cents off the low right now? We had made a low or a high at 416, backed off last week, nudging back higher this morning. As of the report, or as of before this webinar, we were 411 and a quarter. So we're nudging back towards last week's high here as we move into the weekend. I borrowed this from someone on Twitter, talked about the pennant formation that we were forming yesterday. And if we were able to trade higher today, could see a break out of this pennant, which is what has happened here this morning. What would that allow us to do? Well, number one, probably go back to the July high, late July high, 423 3/4, probably in this 423 to 426 area where these highs were made last month or back in July. And then the second target would be the 100-day moving average at 436. So if I need to sell some grain off the combine this fall, those would probably be a couple of targets, maybe the low 420s, maybe the low 430s. Good place to put some offers in. If you look at the other moving average lines, the 9, the 20, they've all turned higher now. And so while we may not be ultra bullish at this point, I think you can make a case that maybe that low is in the market right now, and it was done by the slam of old crop corn that came to the market at the end of August. That said, can we go back and test that area again or go back below $4? Absolutely, we can. We've got a huge harvest coming on. We got the second biggest crop we've ever had coming on. So yes, we can push this market down. But I think here short term, we've opened up a lot of bin space. I think a lot of farmers early on are not going to sell grain. They're going to go to the bins with it. And so at least for the first half of harvest, we shouldn't have a lot of grain moving to the market. You get into the back end, maybe you start to see more selling take place. I've also heard a rumor, and I don't know if it's true, but I've heard a rumor that some banks are leaning on producers to sell. I don't know if that's true everywhere. It may just be a one spot deal, but I've heard that to be the case as well. And so at some point, maybe you see that become an issue that the market has to deal with. But as of last night, we were down 20% from the margin protection base price at 509. We're down 12.5 or almost 13% from the revenue price set back in February last year. So at the 95% level, a lot of policies are probably still going to trigger payments here. We'll get into October. We'll start to set the harvest prices for much of the country. Some areas in the South setting their prices here this month. Now, go back and compare to where we were back in 2014, because that's been the chart we've talked about a lot over the last several months. We really followed that tendency of 14 until just recently when the funds have bought back some of their short position. The one thing that was different in 14, we didn't have the huge fund short position initially in this market. And I think when the crop size was big, funds started selling again as we went into the early part of harvest. And so maybe we don't quite follow exactly what happened in 14, but I thought it was interesting to take a look at that. The other thing I want to point out still in the corn market is the carry and the opportunity that a producer has here this year. I've dropped the September contract off the board. And so just looking at the December as a lead month, September is going to expire here today. So as of last night, we had December corn at 406, and you can see where these other markets are trading, the other months were trading at last night's close. The spread, we got a 17-cent carry from December to March, got a 29-cent carry from December to May, another 6 cents out to July. I use 9% interest. You can subtract off interest from your carry opportunity. Shows you what the net carry to interest would be from December futures on out to May, March, May, July, etc. And so there's still some money to be made in this corn market. In fact, pretty good money. And if you look at the basis levels, probably for the fall gut slot for October shipment, we've probably got some really wide still cash carries in this corn market. So the market is yelling at us, I think, right now to store corn. But it's also, the one thing I would point out in that is the only way to earn the carry is still to forward sell. So instead of looking at December corn, we've talked about going back to 420 or, 430, be looking at the July or the May or whatever you think you can store, even the March, if you want to store corn out into Jan, Feb, March and start moving it when the roads are able to do it, maybe there's some opportunities there for you to earn that carry. And so that's still the name of the game in corn. It was last fall. It is again this year. Still got opportunities. But again, you got to sell the rallies, sell the carry. Maybe July corn at 450, 460, or May corn at 445, 455, something like that. Those look like some good sales targets. For beans, even though there's a carry in the futures market, by the time you subtract interest, there's really hardly any money to be made here. And so what it's really telling me this year, once again, is that if I need cash this fall, sell my beans. And maybe if you want to re-own them on paper, whether you buy the board, whether you buy future options, whatever the case is, but it's not telling me that I can make money, at least on the futures carry. I can't make money in soybeans. Cash, yes, maybe if the basis is really, really wide here at the beginning of harvest, might be some opportunity to store some beans, but the market's going to want your beans. I mean, this is the window where, this October, Jan window is typically when the United States makes its hay and exports. And so without the carry in the market, if I have limited amount of bin space, probably want to store corn and ship my beans. We'll look at beans here in a minute. The other strategy that I still like, a couple of things. Number one, on corn, if I have to move it to market, but I still want to stay in the market, I would consider selling your corn off the combine, hopefully on this bump, and maybe buying an out of the money call option. If I look at the calls, I could buy a 450 call for 10.5 cents. Go to a $5 call for just 3 cents a bushel. That's a March, by the way, and these expire February 21st. That's really, really cheap. And so historically, it's really cheap. These are last night's values, but that's an option versus, just selling it outright. So if I want to stay in the market, give myself a chance, maybe I buy one of these out of the money options. The other strategy I've been talking about for a couple of months now for corn, it's going to go in the bin. If you're nervous that, if Brazil hits on a big crop and Argentina and everything ends up panning out well again, that there is that chance of this market going down. I still like the long put short call strategy, the min-max strategy. And so if I want to put grain in the bin, one thing we've talked about too in the past is, if you've got margin protection insurance or ECO at 95%, you're probably in the money with those policies right now. And if the market goes down, your indemnities are going to go up. However, that's going to quit sometime in October. By the end of October, we will have set the harvest prices for those policies. So where I'm vulnerable is November, December, Jan, and Feb, and I can help to alleviate that price risk by using this March option. Buy a March put option and maybe sell a March call option to offset the cost of it. And so actually yesterday, I should have expanded this box a little, but I could have bought a $4 put for 8 7/8 cents. I could have sold a 460 call for 8 1/8, basically for about even money, have a floor at $4 and a ceiling at 460. Worst case scenario here, two worst case scenarios. What if corn goes below $4? What if we go to 370 or 380? Then I've got a floor at $4 March corn on the 21st of February. What if corn goes above 460? Well, then I'm locked in at 460. And basically I've got a short futures position at that level, and I would have to pay margin on the difference up to where the market's trading at. But as of today, we got March corn at 424.5. I would gladly be able to sell corn at 460. Would I do it on all my bushels? Probably not. But I do think that this makes sense as a way to protect those bushels you're going to put in the bin. And with the market rallying a little bit here this week, going into the close today, maybe not a bad opportunity to look at a strategy like this here this afternoon. Looking ahead to next year, we'll start talking a little bit about that with margin protection insurance in a minute, but we're nudging right back up against this double top that we've had with the August high and the September high right at 450. And so can we trade through it? Maybe. Not a bad level, depending on what your profitability looks like, maybe to start to trickle out a little bit of a hedge for next year. Probably look at the 460 area, which was the July high, and it's where the 100-day moving average is. Both of those nudge just in the low 460s. So not a couple of bad places to be selling. Probably wouldn't get more crazy than 10% a piece at those levels. But you also may want to look at using margin protection as a put option. We'll talk about that here in a few minutes. But as today, the RSI at 57, stochastics moving up into the 80s. Again, not a bad place to reward the market. A lot better than where we were just a month ago, down below 430. Switching to soybeans. This was my most important chart last month. It is again this month, and that's the production between these three big countries. And if you look at the United States at 124.8 million tons in red, Argentina is forecasted to grow 51 million tons, Brazil at 169. if those forecasts come to fruition this year, we're going to be swimming in a lot of beans. And I've said this the last couple of months that to me, beans are the most bearish balance sheet we've got. But nothing goes down every day. And so, we're getting a little bit of a bounce in this market. We do have a little bit of uncertainty right now, but long term, if this does happen, certainly you would expect lower prices in soybeans. So let's go back and look at yesterday's report. USDA shared these slides. Good to excellent rating was unchanged last week at 65%. Normally it starts to flatten out about this time of the year. Last year, 2023, the light blue line, it was continuing to slide a little bit as we went into September. Yield-wise, 53.2 bushel per acre, back above trend, would be a new record high yield here in the United States. And if you look at the states that improved or dropped versus last month, overall, again, this is still a record crop, but several states, several huge bean producing states had records this year. Illinois, Iowa, Indiana, go down into Mississippi. We've got a few states, so a few key states, Arkansas. So several states with some really good bean crops, it looks like here this year. The satellite model, again, shows where the better yields are, really from western Ohio across into eastern Nebraska this year, going to be the prime numbers as you look up into the 60s and as far as state numbers go. But again, one thing to watch is this drought index. The Crop Profit provided this chart, that the drought monitor has shown an increased area over the last several weeks. And so does that eventually cause USDA maybe to take a tenth or two off of the crop? But 4.59 billion bushels of soybeans would be a record production if it stands. And so as of today, at least the bean number looks big. Now, as far as trade guesses, there were some people thought that number was going to get even bigger yet. Didn't really happen. So it was pretty much a neutral report, which I think was seen as a positive for the market yesterday when it came out. So only a couple of little tweaks in the report. Yesterday, USDA increased the old crop crush by 5 million bushels. So that took beginning stocks this year down a little bit. They made some minimal changes in the residual. So net, we dropped 10 million bushels in ending stocks to 550 million. Now, this is still a huge number, but it wasn't as huge as some people talk. We were, looking at some of the numbers thinking we could have been above 600, 650 million. And so the fact that we're not is probably a bit of a relief for the market. Now, one of the positives that we've got for the world has been soybean imports in China. China's been buying a little more lately. Most of that's, I shouldn't say most, a lot of it's been out of Brazil. Some of the purchases lately have been out of the United States here for October, November shipment. So that's a positive. We're glad to see them back in the market. If you look at values right now, though, right now it would tell you that the United States is the market for October, November, December shipment. But it also tells you then that Brazil would be the market. It's got the cheaper beans for Jan, Feb, and March. We'll see what happens as we go forward, whether currency valuations start to play a difference in this. The dollar this morning was down 0.4 of a point. That starts to have a factor. You would think normally that January would be a U.S. month. February would start to be the transition month as we get into the Brazilian harvest. Keep in mind that Brazil's going to plant a little bit later this year because of some of the dry weather. That ultimately might shift some of these beans back into March. And so maybe the United States picks up some extra business for January, February down the road. As of today, doesn't tell you that that would be the case. So a very similar chart, beans is what we got in corn. We're rebuilding stocks in the United States while prices continue to slip in order to try to trigger more demand. A decade ago, 15, we took prices down even further. And so that is still a fear of mine, that prices could continue to erode if we have big bean acres in the United States next year. If demand is somewhat limited here for U.S. beans, if China is somewhat limited on their purchases, can price continue to fall? And I can't rule that out in beans. Again, with the balance sheet we're looking at the U.S. and world level, it would tell you that that is a distinct possibility in the year ahead. And so here's our stocks matrix with yesterday's yield number at 53.2. That was the same as we had back in August. If you were to look at pro farmers, numbers would have been historically bearish. 54.9 bushel an acre would take our stocks back up over 700 million bushels. That did not happen. So as we go forward from 550, what can possibly change? Well, maybe you see a little bit of demand, extra demand at some point. Maybe you see USDA tweak the yield down. Even a half a bushel an acre still leaves your stocks above 500 million bushels. So it's hard to paint a bullish picture here unless acres slip for some reason, but I don't see that really happening. So when you compare the U.S. and world numbers both, unlike corn and wheat, where the world numbers are flat, world stocks are building right now. And part of that's the United States, but part of that has been the size of this Brazilian crop this past year as well. Brazil acres expected to be up this year. Argentine acres expected to go up. So again, it boils down to weather, boils down to La Nina, the rains, etc. But the intended acres are there this year in the Southern Hemisphere to continue to add to this situation. So the funds, what are they doing? Well, they're short 150,000 contracts as we start the new marketing year. Today's report will probably show they've covered some of that short position. So we'll see what the government or the CFTC has to say this afternoon. But it's kind of unusual, actually, for the funds to be short right now, which seems kind of interesting given that harvest comes on, but funds typically have been long over the last several years. Now, a year ago, they shorted on into the early part of the winter when the size of that South American crop continued to get bigger. And so we'll watch and see what they decide to do here this year. A lot is going to depend on weather in the Southern Hemisphere. But again, the chart indicators right now turning back higher the last couple of days. You've got the RSI at 54, stochastics in the 70s. This morning, we had pushed up against the 50-day moving average at 1020 and then backed off. And so, we'll see how we close today, but we hadn't been able to take that out just yet and had not been able to get back up to the high we had from the end of last week. So those are a couple of targets today, 1020, the 50-day moving average, last week's high, the recent high at 1030 would both be some upside potential targets for this market. Hindsight's pretty good, but again, go back and look at when we had wheat in the hot or beans in the hot zone back in March, back in May, back when we had beans reaching up into the 12s. I don't see that happening again here for quite a long time unless we get into a South American weather issue. But certainly this 1030 area would be a great level to be selling some beans, 10 and a quarter. You get back to the late July highs, maybe you get up into the 1075, 1080 area. Yeah, I'd probably sell the heck out of beans under the 100-day moving average. I just don't know that we've got the driver for that aside of South American weather that could take us back to that level. As of last night, margin protection price last night, we're down 22% from where the MP price was set last year. RP price down 12.5%. So again, the higher coverages are expected to probably trigger some payments based on the price drop this year. So they did really work like a put option for both corn and soybeans here this year. Karen Braun posted this the other day and actually pointed out that beans are kind of following what they did last decade a little bit more than corn is lately. And so I thought that was interesting that corn's kind of diverged where beans continue to follow that downward trend. So what do you do in beans? Well, earlier I talked about, the lack of a carry in the soybean market has me, A, wanting to sell beans off the combine, and B, if I want some South American weather something, if I want to keep a card, maybe I go buy some out of the money calls. I could buy $11 calls. Those are pretty pricey at 24 cents. Maybe for the bang for my buck, I go out to $12 for 7 3/8, or somewhere where I could buy something for a dime. And that gives me some potential upside in this market till we get out to the late February. So what's that, about 5 months? That's pretty good, pretty good amount of days protection for a dime a bushel. And so that to me looks like a pretty good strategy. If I'm going to put beans in the bin, then I probably want to look at something different. And maybe again, if I want to look at that min-max strategy on beans, I could buy a $10 put for 26 cents. I could almost sell an $11 call for that money. So for close to even money, I could have a floor and a ceiling at 10 and 11, give myself $1 upside potentially, actually 56 cents because the market's at 10.44 right now. So, not a great strategy there. Again, I think the preferred strategy is to sell my beans off the combine, re-own them with an out-of-money call option if I want to stay in the market. Looking ahead to next year, 1066, where we're at last night or this morning, pushing back up towards this kind of double top, about a dime above where the market's currently at right now. We've rallied 50 cents off the low. RSI stochastics nudging up towards the hot zone. We'll see if they continue higher. I think an obvious target is $11. The 100-day moving average at 1107. We just about got to $11 back in late July. But if you're fearful of those production numbers in the Southern Hemisphere happening, if you think that U.S. acres of beans are not going to drop the coming year, then I think it's probably prudent to start getting some beans priced on the rallies here this year. Finally, wrapping up with cotton. The biggest chart yesterday in cotton was the yield number. Unexpected, the government dropped a yield down to 807 pounds, lowest we've been since 2015. Did not make any changes to the acres, so production did drop. But you can see what happened in cotton, good to excellent rating. Really going back to late July, we've continued to see an erosion of the crop rating into cotton. Acres didn't change from last month, still planted 11.2 million, still planning to harvest 8.63 million acres of cotton. If you look at the yields versus a month ago, a lot of big states saw the cotton yield drop. Oklahoma, the biggest percentage drop, but Texas down 9%, Kansas down 5%, Arizona, New Mexico, Alabama, Georgia, North Carolina, some of the big producing cotton states also yields drop. Overall, down about 4% from last month. Production at 14.5 million bales, back to where we were 2 years ago. The reason for that is acres. It's not because of yield this year that we're seeing the bounce back up. But if you look at the balance sheet, it was friendly. USDA ended up taking ending stocks down from 4.5 to 4 million bales of cotton. So the change was friendly. The demand side still continues to be a battle for this thing. And so, but if you look at the stocks matrix, going forward, I think that there's a decent chance that stocks could end up falling below 4 million bales. We'll see if USDA lowers some of the harvested acreage numbers because of unharvested ground. We'll see what happens with this final yield, but shows you where we're at right now. And if you look at U.S. and world, U.S. stocks building back up, world numbers staying fairly flat. But the big story is demand, as it's been for a long, long time. Yes, production in the United States has mattered. It was a little bit friendly yesterday. The market went up a little bit. It was up a little bit here this morning. But if you're really going to get this cotton market up and rolling, you're going to have to choose through some of those stocks, and that's not happening, as you still point out that China in deflationary mode. This was a story just from this week. And so if you look at their economy, their GDP continues to be negative. What is this? 6 of the last 7 months, they've posted negative GDP numbers. And so, or quarters. And so not a positive when it comes to demand. And unfortunately, we're counting on China for a big chunk of our extra demand. And OA Cleveland at Mississippi State, he shared this yesterday that, demand continues to suffer. A market trading in the face of demand declining at a more rapid pace than production has no place to go. There's no price breakout based on fundamentals, only short covering rally. And that's what we saw a little bit yesterday. And so here's where the funds are at. The funds are short about 40,000 contracts. We'll get a report this afternoon. Probably showed that they covered a few more of those last week. But that is your best chance right now for a rally, is the funds, as it is in most of these commodities. And oftentimes, though, we have to have a trigger. Yesterday's trigger was lower production. Still 4 million bales carryover, still a lot of cotton. So can you get some extra demand to help move this thing along? And, again, the indicators have started to turn higher, but we're really not gaining a whole lot of ground. We're kind of marking time. We go up, down in this thing. Long-term trend has been lower. Can you change that? Can you get above the 100-day moving average? We've taken the other 3 out this week. Can you go to the next level? Can you go above the August high? Can you get above the 100-day at 72.16 cents? If that happens, each time you do something like that, it triggers some fun short covering. And so maybe that's what it takes to get us back up I would love to see we could get 75, 76 cents. I think we'd be happy with that. We'd probably be selling the heck out of it if we're able to get back to those levels. Looking ahead to next year, similar looking chart, still hovering below the 50-day moving average, still in an overall long-term downtrend. Can you change this thing? Probably depends on acres in the United States, but even more so, it still depends on old crop and it depends on demand. And that's still going to be the driver. I don't think I want to be a seller of any of this right now. Get back up to 75 cents, the 200-day moving average. We'll talk about it then. But before then, I'm probably pretty quiet in the cotton market here as we go into winter. So transitioning to talking about government programs, where we're at right now. Well, we only had one crop that the government changed the average farm price in the report yesterday, and that was corn. They lowered that expectation down to 410. All the other ones stayed the same. And why does that matter? Well, we've got the PLC program and the blue numbers over here on the left. We've got the ARC program, which used the numbers in the red box. The crop insurance program used the numbers in the green box last year. And so the discussion last year was, do you do SCO or do you do the ARC program? And both of those are 86% triggers, county policies. And so you start to see, we're seeing a transition in some of these crops with this ARC program. ARC was intended to be a counter-cyclical type program. You probably remember that program several years back. The counter-cyclical program. ARC is similar. They set it up a little differently, but it's an 86% county program, pays on 85% of your base acres for that crop. We compared it last winter to SCO because they're very similar. The biggest difference were the prices they use, and that SCO protects 100% of your planted acres for that crop. ARC only protects 85% of the base acres for that crop. But you can see a crop like corn, we were starting to see an ARC advantage over the crop insurance program. Beans, not yet. Wheat, not yet. Cotton, we looked at the stacks program for it, so that's a little bit apples to oranges. Sorghum, though, seeing an advantage. Barley, seeing an advantage. So the feed grains, a lot of people would have put the feed grains into the ARC program last year. You would have still probably left rice in the PLC program, still left peanuts in PLC. Those programs probably stay in PLC as we go forward. So corn, surprisingly, getting real close to that PLC trigger price. I don't think we're probably going to go below that as a market year average for this year. But looking ahead to next year, and now there's been a lot of press and even more press this week about a farm bill. And I know the farm organizations are really, really, really pressing for a new farm program. I'm going to say something a little bit counter. Sometimes you got to be careful what you wish for. And right at the moment, the ARC program looks pretty good with where we sit right now. And that's because ARC is as I mentioned, a counter-cyclical program. And ARC is using 5-year Olympic average prices. So for the 24-25 crop year, the crop you're going to sign up for next spring, the ARC price on corn is going to be 506. That's a 5-year Olympic average. So we're bringing in the 23 year, we're dropping off, I think, 18, and then throwing out the high and the low and averaging the other three. So the ARC price is going to go up, whereas the insurance price looks like, at least with where we're at today, December 25 corn is going to be going down from where it was last year. Same for soybeans. We're going to go up on the ARC price, down on the insurance price. Same for wheat. And so the ARC program for corn and beans looks like a no-brainer to me for next year, unless you just don't have any base acres of those crops on certain farms, and some people don't. And in that case, you could maybe utilize SCO if you want that 86% coverage level down to where your individual policy kicks in. But for a lot of folks, and this was the case even this year, a lot of folks use their revenue protection up to a certain level, say 75, 80%, used ARC to protect 86 down to, it's got about a 10% band of coverage, and then maybe bought ECO up at the top end, or margin protection insurance, which covers all the way down to your individual policy, and then maybe had a double band in there with the ARC program. And so that you can do that. And so we're going to be looking at utilizing this ARC program a little bit more here for 25 crop. And so that's, I guess, what I want to say here today. So if we don't get a new farm bill, which today I would tell you it doesn't look like we will, then this county ARC program still sets up as the way to go. Now, if we get a new farm program, there's some talk about changing the percent level for both SCO and ARC, maybe changing the baseline numbers for PLC, depending on how much money that the government wants to spend and how much they want to put into this thing. Changing the subsidy levels for some of the crop insurance policies, that's discussed as well. And so nothing is cut and dried yet, but as it stands today, boy, this ARC program looks good for feed grains next year. It looks good for oil seeds. Probably not still for rice and peanuts, but we'll talk more about that as we get into the winter. So crop insurance for this year. Well, I've mentioned this a couple of different times, but the 95% trigger policies this year sure look like they're going to be worth their while, probably worth their weight in gold, actually, because without those and without much marketing having been done, there's going to be a big difference in those that bought the 95 coverages and those that didn't as far as profitability goes. And so here's an example of our indemnity worksheet and matrix. And as an example for Champaign County, Illinois, could be anywhere in the United States. But the top part of this worksheet is just a worksheet going through the numbers. The bottom part, the matrix, shows you then 200 plus examples of yields and prices. But if I assume that the county yield is going to be unchanged this year, if a producer bought 95% margin protection with a 120 protection factor, keep in mind that this is a big difference from what you have with ECO is this protection factor. You can add that 120%. And this really comes into play when there's a payment because the payment's going to add up 20% quicker. And so here's what we know today. These were last night's numbers. We had a corn December futures price at 406. The input prices had already been set with the exception of interest. That'll be set during the month of October, same time the corn price is. But you can see that input prices have dropped just slightly this year, went down about $14 an acre. That makes a little difference in the policy, a little bit of a negative for the policy, but not to the extent that we saw changes the previous 2 years. But if this county yield were to stay unchanged, then you'd be looking at an indemnity right now with the price at 406, you'd be looking at a payment of $195 an acre, which is the biggest number we've seen in a long, long time, and purely based just on the drop in the price. Now you go down to the matrix and look at some, what if the county yield's higher? What if Champaign County comes in at 245.9? Well, at 410 corn, you're still looking at almost $100 an acre indemnity. I highlighted in red 362. The reason I did was that was the low in September futures last month. What if the carry market, what if December corn goes back down to that level? Well, if we go back to 362, now I doubt we would for an average for the month, but you can see what the payments would look like if that were to happen. So point is that now through the end of October, or really about the 2/3 of the way out through October, you've got some downside price protection from these policies, especially this margin protection policy that had the price at 509. Once you get past that, and once we start to lock in this harvest price, now you no longer have downside price protection, which is why I talked about the min-max strategy earlier, buying puts and selling calls on the March contract, which gives you some added protection for, especially for grain going in the bin on out through late February. Looking at ECO, here's our ECO indemnity worksheet. And so the one big difference in margin protection versus ECO this year was the price. We started out with the ECO price at 466 versus margin at 509. And so if we use the same harvest price, and I use Champaign County at 227, this 9% band is worth $98.56 if my APH is 235. Your APH does matter with ECO a little bit, but we're not even at a level price-wise where we would trigger that entire 9% band of loss. Whereas margin protection was, up into the 190 some dollar an area. So that's, again, the two big differences this year with the price, the starting price, and then that 1.2 multiplier that we've got with margin protection insurance. Point is, though, with ECO, we're still in the money. If the market goes down, we're still got another, what, $12 that we could still collect if the price goes lower. Soybeans, here's where we were at last night. Here's a county in Indiana. Input prices basically unchanged. Don't even hardly have to look at those. But if the county yield were to be unchanged with the price at 10.11, because we started at 12.95 last year, we're looking at an indemnity close to $170 an acre. And you can see down in the matrix. Now, I highlighted in red 936. That was the low in August soybeans here about a month or so ago. I don't think we're probably going back to that area in November beans, but we're only, 80 cents above it right now, 75 cents above it. So if we go back down into the mid nines, upper nines, whatever the case is, even if your county yield comes in 8 to 10 bushel higher than expected, you're still looking at triple digit indemnity payment this year. And this will pay down to the level of where your individual coverage would kick in. So if you've got 80% RP coverage, you'd have to have a bushel loss not to collect this on your farm, not to collect this entire amount. And so this margin protection policy really is, does probably deserve a gold star on it here this year. For ECO, we're looking at payments, but again, like corn, not that entire 9% band because the price hasn't fallen that far. And so, from 11.55 to 10.11, that band in this example here is worth about $73 an acre. As of right now, we've only lost 7.5%. So we're still only looking at a payment of about $60. Still good. It was still matter to buy the policy. And if price goes down further, it's still going to matter. But compared to margin protection, not quite as good a deal here this year. So looking ahead to 2025, what do we got? Well, we're about done setting a lot of prices. The winter wheat prices are being set right now. Through today's close, we will know what those are. So we're going to be below $6 in the southern states, going to be at or just slightly above in the northern states. But the market's continuing to go a little higher right now. And so we know that the market's going to be trading a little bit above the crop insurance price here as we finish the pricing window. Two policies that you may want to look at if you want to protect not only bushels at a higher level, but price as well. We've got ECO and SCO both available for winter wheat in a lot of places around the country. Take a look at those if you want some extra dollars of coverage. If your goal is to try to cover your cost of production, it's going to be hard to do with a revenue policy just by itself. So utilizing SCO and or ECO might help you be able to get that done. Looking at the margin protection policy, we're about done setting those prices as well. Looks like that average on corn is going to be at 440. Beans are going to be a little above 1040. Spring wheat's going to be a little under 650. You can see the volatility factors. I don't know. I've been asked why the spring wheat volatility is at 37%. I don't know the answer to that question. We'll see what they put out here once the prices are finalized. When you look at the input prices, urea is down, DAP is up, diesel's down, interest rates down. So overall input prices are going to be down just a tick. Potash is down as well, but not to the point of making up for what we dropped in commodity price, in grain price. And so our margins are going to be tighter. We know that across the board, but historically, we're still not as low as we've been in some years. And so margin protection insurance may make some sense. So if you're trying to decide whether margin makes sense this year, or maybe I wait until February to buy the ECO coverage, here's a Revenue IQ letter that I put out last week. If you haven't looked at that, here it is. You can pull it up and look at it with the market report email letter that I send out daily. I don't know that margin protection is as easy a decision as it was for me in some states last year for a couple of different reasons. And you can kind of see here some of the comparisons between the two policies. One of the advantages that margin protection has is that it sets its price this time of the year. And historically, for corn, this August-Sep window is better than the February average more often than not. For soybeans, it's the opposite. That spring policy period tends to be a little higher. The one big advantage ECO is going to have for next year is that the premium support is going to go up to 65%. from 44. For margin protection, it's still going to be 44% going forward. So ECO will be cheaper than margin protection, but with margin, you're setting the price today and you're getting that 1.2 multiplier available. You can take that off, which cheapens the cost of margin protection. You can take that down to 1.0, which then makes margin protection very similar to ECO. It's just a question then of which pricing window do I want, and do I want the input costs involved, which margin does and ECO does not. One other factor, which tends to be a big one for a lot of folks, margin protection really provides more dollars of coverage because it's not limited. ECO is a band. It covers from 95 to 86% as a band. We know going into the year it's going to be worth at most $90 some an acre unless the harvest price goes up. With margin protection, it's going to protect dollars from 95% on the county all the way down to where your individual policy kicks in. So if I've got 80% coverage and my yields are better than the county, then I've got 15+% essentially band of protection with margin protection versus the 9% with ECO. So margin might cost you more, but you're going to pick up more dollars and you're going to pick up the multiplier if you decide to utilize that as well. Both of these act like put options to me. I go into the year not expecting a better or worse yield, but I think I know where prices are at. And if I'm concerned about price drop, and I wrote in something else, but if I think that we could see a 10% price drop, then I think that these make sense. And 10% on corn is what, 40 cents. If I think we could be down 40 cents next year, that makes a lot of sense for me to look at. For beans, maybe that's $1. Do I think beans could be down $1? Boy, probably could if we start at 10, 10 and a half, 10.40. Could we be down in the low 9s? Back in 15, 16, we went down to the mid 8s. So if Brazil, Argentina raise a big bean crop, could possibly happen. If I want protection, I've got policies here to do that. So these are the questions I was asking myself at this time a year ago. I think these are still valid. These are some things that I could do right now. Number one is to do nothing at all. Just wait and see. Sit on my hands. Let this period pass through the end of September, see what happens later on. I could forward sell corn today at 447, 448 December. I could sell some beans at 1060 for next year. Most of us won't do that because we still have a whole lot of crop to sell for the 24 year. I could buy put options for next year. Those are going to be awfully pricey because of the amount of months of coverage I've got. I could buy margin protection insurance here in the month of September if I want to get something locked in. And I do like that peace of mind that margin protection gives me, having some floor put in this market. If I look at 440 times 95%, at least I know I've got a floor. Or 1041 times 95%. At least I know I've got some floor under this thing for next year. If everything goes to heck come February, I've got something set in place. Or if I don't, I can just wait and buy whatever coverage I want to look at in the month of February. So to me, it boils down to this question right now is if I think 25 prices are high compared to where they're going to be in February, and if I want more total dollars of coverage with that high policy, then unless I'm going to forward sell, I'm going to buy margin protection. If I'm not afraid of prices dropping significantly between now and February, and I maybe want to save a few dollars, even though I'm going to get less dollars of protection, I could still wait and buy ECO if I want that 95% trigger. I could wait until February, March. So to me, that's what the question boils down to right now. I don't have the answer. Every day, I feel like I kind of change my mind a little bit on this. I think it really boils down to your personal decision on how much coverage you want, what dollars of protection you want. Does it cover my cost of production for next year? What do I need to do premium wise? I know that comes into the equation, even though, you could argue that maybe it shouldn't, but it does matter. And so all of these questions need to be answered between now and the end of September. So if I'm concerned about additional price drop, I go back and look at the long-term picture of monthly chart on corn, when we've taken price down so far right now. If I think that, this is just a month ago, we had September corn down to 360.5. If I think that that's ultimately a target or even below that, then, maybe this makes some sense to lock something in with margin. If I look at the 25 worksheet for next year, one thing to point out, several of these counties and several states are going to see an increase in their county yields next year. That's going to be a big positive. You can look at the matrix, see where it would start to trigger payments with both yields and price. Same with soybeans. We're in this downtrend. Will that continue on into next year? Are we going to take prices for good down below $10 at some point? If we do, then maybe margin or ECO does make sense. Again, we can print out this worksheet, kind of show you where things are at as of right now. And you can look ahead and say, well, if we had a 5% better yield next year, where does the price have to go to trigger a payment? So coming up, we've got several things. September 30th is an important day. We'll get our quarterly grain stocks report that day. Tells us where the ending stocks were at the end of this year, thus the beginning stocks for next year. We get our fall sales closing date that date as well. So that's the final day for making decisions on insurance for winter wheat, for margin protection, corn, beans, and spring wheat. The next WASDE report from USDA is October the 11th. We'll talk about it and more on October the 14th when we host the aftermath next month. The 8th is our following month report. The 11th, we'll have our next aftermath. So a lot of things coming up. Of course, harvest. For all the producers that are on with us, we hope you have a safe and successful harvest. For the agents that are on, if you've got questions, feel free to shoot them at me. We'll be happy to answer those. We'll be talking more in the letters, newsletters and such over the next couple of weeks about winter wheat coverage, about margin protection as well. So with that, we hope you have a great rest of your day and a great weekend, and I'll look forward to visiting with you again real soon.